Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. One more thing before we get started, you'll see in the description of the video, there will be this section here, which is click on this link for descriptions links to the other videos mentioned in this preview on different topics about the SPX indicator. So this is a Google Drive link. I'll show you where it takes you to now. So when you click on that link for the Google Drive, this is where it takes you to, which as you'll see is a list of different topics and links to the videos on those specific topics. These topics go into more detail. We may reference some of these topics very briefly in today's video, but when we reference to go look at the video that provides more details, then you'll just simply click on this link and go to here, and then you'll be able to click on the link that you want to see a more detailed video on a certain topic. Thank you. Hello, in this video we're going to be taking a look at the Tuesday, November 4th, 2025 trading session for the SPX CBOE index. We'll be utilizing the Day Trading GPS SPX Daily Key Levels indicator, specifically the newest version of that indicator, which came out a few weeks ago, the V2.0 version. Okay, today's video is going to be shorter than usual. I don't have time to make the normal full video today, and so we're not going to go through a lot of the details that normally we would go through. So I would ask that if you are seeing this video for the first time, as far as seeing a video on this particular indicator, that you take a look at, if you'd like to see more details and a full video session of the indicator, which will go into more detail than we'll go into today, then watch some of the more recent videos that we've made, which are approximately an hour to hour and a half long. Today's video, we have some time constraints. We're not going to be able to do the same length of video and go into as much detail as we normally do. Also, you can reference those links in the Google Drive, which we pointed out in the preview to the video, that go into detail on other topics concerning this indicator as well. Okay, so for those that are not familiar with this indicator, I will run through very briefly how this indicator works. Like I said, you can watch some of the other videos to see a more full version of this, but just briefly, the way this indicator works is it works on two different symbols for SPX. One is the symbol it's on now on TradingView, which is the SPX symbol. So you look up SPX, and then you look up the SPX symbol that is under the CBOE exchange, and that is the official SPX index that everyone follows. You would use the indicator on this symbol for trading SPX options. The indicator also works on a second symbol, the SPX 500 8 cap, which I'll show you that chart now. So on TradingView, it's SPX 500. Then you would look for SPX 500 under the 8 cap exchange. There are a couple reasons why you would use it on this particular symbol. If you're trading SPX index options and normally just look at the CBOE chart, the reason that you would want to have a second chart open with this symbol is because you can get the levels for CBOE SPX 30 minutes early before it opens at 9:30, and you can get them at 9 o'clock when it's on this symbol. The way PineScript TradingView works is that even though our indicator is already analyzed and knows what the levels for CBOE SPX are going to be for today's session at 9 a.m. It cannot show them until the first tick at the 9:30 open on the other chart, the SPX CBOE chart, because PineScript has a limitation that if that particular symbol is closed, that the indicator, it will not draw the new lines on the indicator for the new session until that session open is the symbol is currently closed, which at 9 a.m. it is closed. However, this symbol is open at 9 a.m. because it is a Forex CFD. So while it's on this symbol at 9 a.m., you can get the levels for this Forex CFD here in this table, which are the same levels here. And then the second table here shows you the CBOE SPX key levels for the session that starts at 9:30. However, you can get them at 9 a.m. Another reason, and that allows you to get a 30-minute jump on the CBOE SPX session to do a little planning, and just gives you time to do some additional analysis as well. One reason you might just want to use the indicator on this SPX 500 8-cap symbol by itself would be if you just trade through a Forex broker, and that's how you normally trade. Let's say you normally trade Forex currency pairs, and you normally trade indexes through Forex CFDs and metals through Forex CFDs. Then or if you're involved in a trading challenge with FTMO or one of the other Forex-based trading challenge companies in which you can take a trading challenge, try to pass the trading challenge in order to qualify to get a funded account with them, which they provide the risk capital, then you would use this indicator on the SPX 500 8-cap chart to trade SPX through Forex, as opposed to trading CBOE index options. However, most people do use this indicator to trade index options. However, there are a few that use it for the Forex trading challenges. Alright, now we'll go back to the main CBOE SPX chart. Okay, as you can see, we're on a 2-minute chart. The recommended chart time frames for the daily key levels trading strategy with this indicator are from 1 minute to 5 minutes, with the recommended chart time frame that you will see in all of our videos out of that 1 to 5 minute range being the 2-minute chart time frame. Some people use this indicator along with other indicators that they like, and they may prefer a different time frame on those other indicators, and so if you have a different time frame between 1 and 5 minutes that you prefer over 2 minutes, you can use this indicator on another chart time frame. It does work on chart time frames of up to 30 minutes. However, for day trading purposes and for purposes of trading the daily key level strategy that we outline in all of our videos, we recommend that you use a chart time frame between 1 minute and 5 minutes, and the recommended specific time frame out of that range is the 2-minute chart time frame, which you'll see in all of our videos. Like I said, I'm not going to have time to run through a full session video today explaining every little detail as we normally do. So please watch the other videos that we've made recently if you are new to this indicator and would like to see a more full presentation. Just real briefly, the key levels that you see here, you'll have the bull bear key price level, which is the most important key level that the indicator gives and this level is updated every session. Also, we have the main R1 through R6 levels and main S1 through S6 levels. Those are also updated each day after the indicator's various algorithms do the analysis in the morning. Also, we have these additional key levels, which are the SPX pre-market high, pre-market low, yesterday's daily high, which is the RTH session yesterday high, YDL, yesterday's RTH session low, and YDC, yesterday's RTH session close. Those levels are very important as well in the context of the session. Generally speaking, in order for there to be a breakout day, it is going to have to not only close above the bull bear key price level, but also close and stay above the pre-market high. Conversely, for bearish, typically it's going to have to at least trade below the bull bear KPL, and for a substantial down move, it's going to have to trade through the pre-market low as well and start consecutively closing candles below that as well. The YDC, YDH, and YDL levels are also very important. As you'll see today, the importance of the YDL level comes into play. But these levels are also important, especially when they are in confluence with other levels. And also depending on what type of market scenario that we're in, whether we have a poke above day, a poke above day, a poke below day, or an inside range day, or a full gap above or full gap below day. Okay, so in today's session we have a gap below. As you can see, this was the previous day's close, YDC, and we have the opening candle here. Before we move into the trades for this session, I will briefly run through the main key levels. So the main key level is going to be the SPX bull bear key price level, and after the indicator did its analysis this morning, that level for today's session is 67.8146, bullish above and bearish below. So this will give you the bullish or bearish bias for the session. However, that does not mean that you cannot take bullish or bearish trades off of the other main levels. This is just going to be the main key bull bear pivot for this session for bias, and it is the main level for trading both at the 9:30 a.m. open candle if you decide to take the 9:30 a.m. opening candle trade, and it's also going to be the key trading level during the opening moments of the session, say in the first 5 to 15 minutes of typically 95% of the 250 or so sessions that you'll see a year. The other levels that you'll see here, besides the main R1 through R6 and S1 through S6 levels, are these midpoint levels and QL levels. The QL levels and midpoint levels have several different purposes. The QL levels are primarily for use for tight stop losses above and below each main level. As you can see here, we only have the QL above and QL below the bull bear KPL turned on. That is because this is the default look of the indicator, where the QL above and QL above are turned on, as well as the midpoint above and midpoint below the bull bear KPL are turned on by default. The midpoint levels and QL levels above and below can be turned on above and below each of the other main levels in the user control panel. However, by default, since the bull bear key price level is the main trading level at the beginning of every session, that is why these levels are just enabled on startup as far as the midpoint levels and QL levels, because the main focus at the beginning of the session is going to be in this range here. As we move throughout the session and later on in the session, the other levels come into play, and you can turn on the QL above and QL below, as well as midpoint above and below each of the other levels as you would like. You can also set those as defaults if you prefer that over the standard default look that the indicator comes with. So you can customize this indicator to have the levels on display that you prefer on startup if you prefer a different look. Okay. One point I want to make clear before we move on here is that you can take bullish and bearish trades off of the bull bear key price level as well as any of the main R or S levels. Typically, and as we saw today, the other main R and S levels are not going to typically come into play until later on in the session. We do have a video, as pointed out in the Google Drive link at the beginning of this video. You can click on that Google Drive link in the description of this video, and you will see a list of different topics of different videos on specific various topics concerning different aspects of utilizing this indicator. One of those videos is on taking bullish or bearish trades off of the other main R levels and S levels, and also goes into the two different types of trades, both standard trades at trade entries as well as the more conservative trade entries which take additional confirmations. So I would invite you to look at that video, as it will go into more detail about how to utilize this indicator throughout the session on the other main R and S levels to take bullish and bearish trades. And we will see one of those trades taken on another level today, the R2 level, and how that played out. Okay, as I said, I'm not going to go into every little detail. We're just going to get right into the trades. I wanted to give at least some sort of general overview, but if you do want to see a lot more detail about how this indicator works and many other aspects of it, then please watch one of the other full-length videos, which is about an hour and a half long, which or hour 15 to hour and a half long, which if you look over the last 6, 7, 8 SPX videos that we've made over the last 2 weeks of sessions, then you can watch those and get a more fuller aspect if you're not already familiar with this indicator. Okay, so here is the 9:30 a.m. opening candle for today's session. As you can see, this was yesterday's RTH session close, and we have quite a gap down today. In the opening candle here, you can see that it did open above, but it crossed below and closed below. We do have a significant wick below as well, but it closed here just slightly under the bull bear key price level. It's a pretty wide range candle, and this, if you're going to take a 9:30 a.m. opening candle trade, this is your bearish entry signal. Why is this a bearish entry signal? Because the candle, and it's a bullish entry signal if you're taking a 9:30 a.m. opening candle trade, because it's closing below the bull bear key price level. It doesn't matter as much that it crossed below and then closed below. That's what happened in this case. It could have opened below, stayed below, and closed below. It could have also opened above, gone above, but then closed below. The main point is, no matter how it travels intra-bar, the main point is that it is closing below. Conversely, if it had closed above, then if you wanted to take the 9:30 a.m. opening candle trade, then instead this would be a bullish trade, because the main thing would be it would be closing above the bull bear KPL. It would not matter if it had opened below and then crossed above, because it would have closed above. It could have also opened above, stayed above, and closed above, and that is also a bullish entry signal. So the main point of both the bullish and bearish scenarios is if you're going to take the opening candle trade, is where is this candle closing? And that is why you're not entering your trade with your call or your put until you see the close. Because as we see here, this is a pretty wide-ranging candle. This is a candle of almost 20 points or so here. Maybe not 20 points, but let's see, 67, 73, all the way up to maybe 60. So it's almost about 16 points. Still, that is a pretty wide-ranging candle. So in any event, you have some pretty wild action here on the open because you have this such a significant gap down that you have people jockeying for a position here. And so it's important to wait to see where the close is and not just jump in early intra-candle, especially on the opening candle. Keep in mind that there is no rule or obligation with the daily key levels trading strategy that you have to take the opening 9:30 a.m. candle trade. You can simply ignore the first candle if you want, wait for price action to play out, whether that's the first 5 minutes, the first just couple of minutes, the first 10 minutes, 15 minutes, 30 minutes, or even the first hour. Some people prefer to let the opening range play out, whether they consider the opening range to be the first 5 minutes, the first 15 minutes, the first 30 minutes, or the first hour. They want price to breathe a little bit, and then they want to be more picky about where they particularly want to enter a trade in on and not just jump right in. However, if you've seen a lot of our videos, the way that we use this strategy is that we do take the opening candle trade unless the opening candle is out of range in an aberration. Then it doesn't matter if it closes above or below because it's too far out of range. And we have a video in that Google Drive link which specifically goes over the 5 to 10 times a year that something like that happens, and when you would want to avoid the 9:30 a.m. opening candle trade, even on a close above or below. And there is an accompanying document, PDF document to that video, which also goes into more details about the 9:30 a.m. opening candle. Okay, in this case though, this is within range. So this is a bearish signal. This is a bearish entry. The standard play on the daily key level strategy is that you use the at the money strike closest to the level that you're trading. And then of course, if it's a bullish trade, it's a call, and if it's a bearish trade, it's a put. You can also use out of the money strikes, and we do have a video on those how to determine the out of the money strikes that you can use off of any level, whether it is a bullish or bearish trade. That's also in the Google Drive link of one of those descriptions and link to that specific topic. And we also go over it in some of our other more lengthy videos. We're not going to go into it today, but I do feel the need to explain that so you'll know that you do not always have to take the at the money. The at the money is simply the standard play, and that is going to be the only one that we're going to be go over with today. Our other recent videos also go into comparing out of the money strikes to at the money strikes, as well as the entry prices and how the prices compare of at the money and out of the money as they progress through either profits or losses throughout the session. We're not going to do that today. We're only going to be using the standard at the money strikes in today's video. So the standard at the money play is the at the money. 67.8146 is the level that we're trading, the bull bear KPL. The closest strike at the money strike to that for SPX is 67.80. This is a bearish entry signal, so that's a 67.80 put. The price for the 67.80 put on the 9:30 a.m. candle close is $18.72. That means that one put is going to cost, one at the money 67.80 put is going to cost you $1,872 because you multiply that cost times 100, and that is your cost of one option. What about stop losses? Well, you take the level that you're trading, the type of trade, bearish. Your tight stop loss is going to be the QL level above the level that you're trading on a bearish play. The standard stop loss is going to be the midpoint level above the level you're trading, the main level you're trading on a bearish play. Conversely, if this was a bullish play, it would be the reverse. Bullish play off of this level, tight stop loss is the QL below, and the standard stop loss is the midpoint below. So in this case, bearish play, tight stop loss is this level, standard stop loss is this level. As we can see in today's session, both of the stop losses were hit on the opening 9:30 a.m. candle trade. So whether you use a tight stop loss or you instead used a standard stop loss, your first trade, if you took the 9:30 a.m. candle trade, is a loss. If you use the tight stop loss, then your loss is $342. Why? Because on this 9:42 a.m. candle, now this is the 9:40 a.m. candle, however this candle did not reach, even though it looks very close here and looks like it touches it, it does not. It fell short of it, however the next candle not only touched it, but went above it. The losses that we're showing here are the worst case scenario, meaning the worst price that you would have gotten stopped out at. If you're using the level-based stop loss, however, just one point of clarification here. If you're using a level-based stop loss, which you can do in Thinkorswim and Interactive Brokers, and other brokers also offer the level-based stop loss, meaning the price, using the price of the underlying as opposed to the price of an option for the stop loss. That video is also in the link in the Google Drive. Off of that Google Drive link, there's also a link to a stop loss on options video with Thinkorswim, which shows you how to use that feature so you can do your initial stop loss based on a price level, not the price of the option. So with this indicator, your initial stop loss is based on a level. However, later on, when you're adjusting your stop loss to break even or better, after it hits certain targets, then you're changing to just the standard price of the option, moving your price to break even, what you paid for the option, or break even or better. And you'll see, if you've been looking at some of these comment boxes, in today's session we're not going to go into the whole stop loss adjustment, mainly because I don't have time to go through all of that. So I would invite you to look at some of our other videos, and it'll show some of our other more recent videos where we go into how to adjust your stop loss when it hits certain targets and how to manage your trade through the different targets with your stop loss to break even or break even and better, or scaling out if you're trading multiple contracts. In today's session, we're just going to look at trading one contract, and we're not going to have time to go into all the other aspects. So I invite you just to watch one of the more recent videos where we do go into that fully. Okay, so this is the worst case scenario. You could have gotten stopped out at a better price than this, because you can see the worst case scenario is this high of this wick here, because as it's going up, your stop out price is getting worse. However, with your level based stop loss, you would have gotten stopped out here. But for purposes to just show, I think that it's best to just show the worst case scenario on that. So, but I do want to just point out the context of, it could have been less than this or less than this. Both of these are the worst case scenario. So on the tight stop loss, you had a $342 loss. The standard stop loss is this candle here. As you can see, it hit that and went above it, wicked above it. So again, you would have gotten stopped out when it triggered from this level. This would have been a $520 loss. So the first opening candle trade, the bearish entry, is a loss no matter which stop loss you use. Now, as I pointed out earlier, you do not have to take the 9:30 opening candle trade. We do, and as we show in our videos, normally in all of our videos, we show the 9:30 a.m. opening candle trade. However, in this video, I just wanted to clarify this point, that you do not have to take the 9:30 a.m. opening candle trade. There's no rule or obligation with this strategy to do that. So in today's video, we're pointing out the scenario that if you did not take this trade, meaning you didn't take this bearish trade, that means you weren't stopped out here. And since you didn't take this trade, if you didn't take this trade, then what is the first available trade opportunity? Now, you could have waited later on in the session to even take your first trade up here on this bearish trade off of R2. However, the first trade opportunity, if you wanted to ignore the 9:30 a.m. candle, or let's say you even missed it, you went to the bathroom or got something to eat, or maybe you just weren't at your desk. Well, no matter what the reason that you did not take the 9:30 a.m. opening candle trade, the first available next trade opportunity is this 9:40 a.m. candle close on a close above the bull bear KPL. So again, standard play is the at the money call at the money strike. In this case, though, it's a call strike because it's a bullish play. So it's the same strike for the standard play, 67.80. However, in this case, a call strike. The price for the 67.80 call strike on this candle is $23.30. The standard stop loss is now the first midpoint below. Remember, on this bearish entry, it was the first midpoint above for the standard stop loss. But now, since this is the same level we're trading, it's a bullish trade, it's now first midpoint below. And the tight stop loss is the QL below. In this particular trade, neither stop loss was breached before hitting targets. One thing I want to point out before we move into the next comment here is all of the prices that you see here concerning this bullish entry are going to be on this entry here, which is paying a higher price of $25.40. Why? Because this is the trade of the 9:30 a.m. candle. I'm pointing out this trade for those who want to ignore this trade, don't want to do 9:30 a.m. opening candle trades for whatever reason. For whatever reason you didn't do this trade, this is your first available trade opportunity, next trade opportunity here. If you did take this trade and you were stopped out then the next available trade opportunity is this 9:48 a.m. candle here, because this is a close above the bull bear KPL. We're already stopped out. We have this big breakup candle here. We have this sideways consolidation in which we unfortunately got stopped out. And this candle is still in range. In range, I'll reference that video again I talked about that's in the Google Drive link in one of the descriptions and links from that video about 9:30 a.m. candles that you do not want to trade, and then ones that are in range, and that whole PDF document that goes along with it. This is still within range. And remember, we have quite a gap down, so we're expecting some wild action in the opening part of this session due to this extreme gap down. So we're getting a whipsaw back up. So the main reason, though, is that it's still beyond all those other reasons that I just pointed out, the ancillary reasons or context. The main reason is because it is still within range. We just got stopped out. This is still within range. So, and this was a pretty minor loss, relatively speaking. So this is a bullish entry. The 9:48 a.m. candle close, 67.80 call is 25.40. Those are your stop losses. All right. So what about exits? Well, that depends on whether you're a scalp trader or a regular trader with this particular indicator. There's two different types of trades with this indicator. We're not going to go into all the different nuances of those today, but simply if you're scalping, you're looking for a one level move in your favor, and then you're closing out all of your contracts, whether you're trading 1, 5, 10, 20, however many. There's no stop loss adjustment on scalps. There's no scaling out on scalps. You're looking simply for a one level move in your favor. How is that one level determined? It's determined from the level that you're trading from and the direction that you're trading. This is the level we're trading from. Direction we're trading is bullish. We're looking up. This is the, even though it's kind of masked over by the candles here, this is the R1 level, 67.9806. One level up, that's your scalp. If we were scalping from R1, then R2 would be our scalp target on a bullish trade from R1. If we were doing a bearish trade from the BBKPL, then S1 would be our scalp on a bearish trade. It's simply a one level move from the level that you're trading in the direction you're trading. So at 9:50 a.m. on this 67.80 call bull entry, the price on the candle close was $29.70. The profit is $430. However, remember that we're not going off of this entry here. We're going off of this entry because we took this. If you didn't take this entry here and you instead took this entry, then you don't have a loss that's offsetting anything, as this was your first trade, and this would have been your exit here, and then you would have made more than $430 because your entry was $23.30, not $25.40. So you could add about $200 to this. So if you got in here, scalped, and got out here, then your profit's about $630 with no offsetting loss because you didn't do this trade. However, here 25.40, it's now 29.70 here on the scalp. So if you're getting out here on a scalp only, profit 430. However, we still have a net loss of $90 because we used a standard stop loss and we had a $520 loss. So we have a $520 loss here, 430 profit here from this entry. So we have a net loss of $90 if we're only doing a scalp. And if we took this trade here and then took this trade here. If you took this trade here only because you did not start out taking this trade, then you would have a $630 profit here. Okay, regular trades. Regular trades, the minimum required move in your favor is 1.5 levels. The ideal minimum move is 2 levels in your favor. Like I said, I'm not going to go into the adjustments on these trades today. I'm simply going to point out what the prices are. You can look at the other videos we've made recently that will go into that aspect of it. 1.5 level move is simply the level that you're trading. That's one level here. The midpoint above that is 1.5 levels. It hits it here on this wick. As I mentioned earlier, the Thinkorswim and the Interactive Brokers and a few other brokers offer both stop losses and take profits based on the price of the underlying. So you can get out on these wick touches, or you can just get out on a candle close. The choice is up to you. But if you use a broker like that, that offers that feature for both stop losses and take profits, that can trigger the stopping out or the take profit exit based on a touch of the underlying hitting a certain price, then you can do that. Okay, so in this case, 1.5 level minimum required move hit right here on the 9:54 a.m. candle. Price on the candle close, 34.30. Price 890, net 370 after deducting standard SL stop out. Profit 890 minus $520 loss. We're using the standard SL on these losses against any profits because that is what we use. That's the recommended one to use. However, I do understand that many people prefer to use a tight stop loss. That's up to every trader to decide for themselves and their own risk profile. There are some pros and cons of each. Obviously, a tighter SL, when you do happen to get stopped out, it's going to be less money. However, they're more prone to getting stopped out, so you may get stopped out more times, and it may all work out to be almost the same if you're getting stopped out on more trades versus getting stopped out for a larger amount on less trades. But that's really just up to each trader to decide for themselves whether they're going to use tight stop loss or standard stop loss. Okay, so here at the 10:18 a.m. candle hits R2. That's the ideal minimum move for regular trade. Price on candle close 39.47. Profit $1,487. Net $887 after deducting the $520 loss on the opening trade. Now remember, if you were in this trade here because you did not take the opening trade, then you have no loss that you're working against, and you would have a 23.30 entry price, and up here you would have 39.47. So you would have $1,600 in profit up here, And here, where it's 34.30 at the minimum 1.5 level move, you had 23.30. So you're looking at $1,100 here. All right, now we're coming into one of the other key levels, the YDL level. Yesterday's daily RTH session low. Now, this YDL level, as you can see, is pretty far away from yesterday's close. This is 68.20.62. This is 68.51.97. So the difference between yesterday's daily low and yesterday's daily close is about roughly a little bit over 70 points. They're not very close together. So this is a very important level. It's at R2, it's YDL, and we have this huge gap between R3, YDC, and this YDL level. So one thing you have to keep in mind here is that we have a significant gap down. If it breaks above this level and holds above this level, then it's likely at least going to the midpoint, which we don't have turned on. It's going to at least it should at least go to the mid R2, R3 level, and it's likely perhaps even going for the full gap fill. So up to the YDC level. But that's not what price action is showing us here. It's showing us that we have a candle here with this wick on top. It's kind of a reversal candle here, although we are in a 2-minute chart. This would be a little more prevalent on a longer time period chart than 2 minutes. However, nevertheless, as you can see, it stops just a hair below the YDL level. And then we get a longer candle, which encompasses all of this candle and much more. And now it's headed back towards the R2 level. Then it slices through the R2 level here. Then this wick goes back up to the R2 level. So this topping action here, combined with this YDL level being right here, along with this huge chasm of space here. I mean, this is, you know, this is basically 70 plus points here. This is a long way up to here. So we're not even seeing it even close above this level, and it's not hanging around this level. So this is more of a topping action here. So the prudent thing to do here is to, if you didn't already close out, as I'm saying here, close out, call if not closed out already. Remember that this is the ideal minimum 2.0 move. This is the minimum required 1.5 level move. Now you can make adjustments here and try to stay in this trade. And as you'll see, if you look at our other videos, we go over all that. I'm not going to go into that today. You can look at those in the other videos of what those adjustments mean. But in this is topping action. You're out of this trade, and now we're looking for another trade opportunity. And this is a bearish opportunity. And like I said before, if you're of the mindset that you prefer to wait till later on in the session, this is basically 10:30 right here. This is about almost getting towards 11. This is more towards the 11 o'clock. This is the first hour right here, an hour and a half. You could have instead waited until here to make your first trade if you wanted to. And your first trade would have been this bearish entry off of R2. It really just depends on how you like to play the session. This indicator has a historical BBKPL and historical main R and S levels feature, which allows you to go look at previous sessions so you can get an idea of how previous sessions play out and where bearish opportunities may exist consistently off of other main R or S levels, or where other consistent bullish opportunities exist in recent sessions off of other main R and S levels. So this could have been your first trade here. As I said, you do not have to take these trades. You're looking for trade opportunities off of the main either BBKPL or main R or S levels. So here you have this first trade opportunity here on the cross and close below. You also have this additional confirmation opportunity here if you wanted to wait for additional confirmation. Then you could have entered here off of this after wick touch and close below. So here we have both pointed out with the entry here, or if you instead took the entry here. In this case, the level we're trading is the R2 level, 68.1466. The closest strike to this at the money standard play is going to be the 68.15 strike. In this case, since it's a bearish entry, it's a 68.15 put. The 68.15 put, the price on this candle here, the 10:44 a.m. on the candle close, is $12.80. On the alternative entry here, on the 10:46 a.m. confirmation second candle close, the 68.15 put price is $14.80. So you're paying $2 more or $200 more per put for waiting for additional confirmation. Now, your stop losses on this, I don't have the levels on the screen for this particular screenshot. You would simply turn on the QL above R2, and that would be your tight stop loss on this bearish play. Your standard stop loss on this bearish play would be the mid R2, R3 level, because that's the first midpoint level above the level that you're trading this bearish trade from. And that stop loss would have been right about here. Again, I don't have it turned on, but that is where the mid R2, R3 level would be for the standard stop loss. In this case, neither stop loss was hit. Here we have the one level move on a scalp, as I pointed out earlier. R2, a one level bearish scalp from R2 is one level down to R1. As you can see here, it hits R1 on this wick. So here we have the price on the low wick touch is 20.40. The price, the profit is $760 if you entered on the 10:44 a.m. candle and paid $12.80, or the profit is $560 on the scalp if you waited for this candle to enter and paid $14.80. Here we have the 1.5 level move. Now remember how we determine how many levels is from the level that we're trading. The direction we're trading is bearish, down. One level's here. The next midpoint is the half level. That's 1.5 levels. So the mid BBKPL R1 is 1.5 levels down from R2. So at 12:16 it hits the 1.5 level move, the minimum required move for the regular trade. The price on the candle close here is $29.57. The profit $1,677 if you entered on the 10:44 a.m. candle, or $1,477 if you entered on the 10:46 a.m. candle. At 12:18 we have a 2-level ideal minimum move to hitting the BBKPL. It's a 2-level move. We've gone from R2 down 1 level, 1.5 levels, 2 levels. The BBKPL is 2 levels below the R2, so that is the 2-level ideal minimum target for a bearish trade from R2. The profit on this, based on the price of the candle close of this 12:18 candle, $34.65. The profit $2,185 if you entered on the 10:44 a.m. candle, or $1,985 if you entered on the 10:46 candle. And finally, at 1:18 p.m. it moves down another half level, and now we have a 2.5 level move to mid BBKPL S1. So we have 1 level, 2 levels, another half level, that's 2.5 levels. Price on the candle close $42.26. The profit $2,946 if you entered on the 10:44 a.m. candle, or $2,746 if entered on the 10:46 a.m. candle. Remember, all of these are based on one contract. So if you're normally the type of trader that's trading 3 contracts, then you would multiply either the loss or the profit by 3 if you're trading 3 contracts. If you're trading 2 contracts, you would multiply this loss or profit by 2. If you're trading 10, then you would multiply it by 10. Okay, that's going to conclude today's video. As we mentioned at the beginning of the video, if you are interested in purchasing this indicator, you can email us at daytradinggps@gmail.com to request a discount promo code, and in return for you taking your valuable time to watch this video today, you can send us an email to request that promo code, and we will send you one that will give you a substantial discount on your purchase of the indicator. All of our indicators are sold currently on a 1 payment for lifetime access basis. That means you make 1 payment, you have access to the indicator for life. That also includes any updates to the indicator that we release in the future. It also includes any future enhanced versions of the indicator that we release in the future. We will be releasing another enhanced version of this indicator very near in the future that will be Daily Key Levels V3.0. The price will be going up from the current price once we release V3.0 because it has some substantial feature enhancements. And but if you go ahead and buy the indicator now, then you will get that V3.0 version at no additional charge, and you will also get any additional versions or enhancements that we make in the future at no additional charge as well because of your lifetime access. Again, thank you for watching this video. If you did like the video, please like the video as it helps with the YouTube algorithm, and please subscribe to our channel if you'd like to be notified when we release additional videos in the future. Thank you again, and we wish you much prosperity in all your future trading endeavors.